Hello and welcome to Master Trader, where you can learn to use simple market and stock analysis to make money in trading. I'm Greg Capra. Today I'm going to talk to you about how not to use technical analysis, because the majority of ways that it is used will lead to a lot of confusion and lost money. Now we're going to take this a step at a time. I'll do it in multiple videos, but today let's start with the concept of Fibonacci retracements and the use of trend lines. What I have here is a monthly chart of the S&P 500 using the ETF SPY. So it was started back in 2009 after that rather large correction, and this is where the move began. So let's take it a step at a time, as if you were using Fibonacci retracements to make a decision as to where to buy. Now, the first thing that comes to mind is, well, where do you draw the lines from? This one is relatively easy, just picking that low and that high, and let's just forget about this for now, because what we're dealing with is as if we were just looking at this. And what we see happen is prices pull back, and that first line is that 0.382 retracement, and the middle one is 50%, and the bottom one is 0.682. I don't remember the exact numbers, to be quite honest, because I don't really pay attention to it. Now, what you will find probably 95 to 99% of the time is that when one of these fib lines actually do line up with an actual reversal, you're going to see some support to the left of it anyway. And so these lines do not find support. They are just the holy grail type of analysis that's used to try and lure the majorities into using these kind of tools to find support and resistance. Let's continue, and I'll show you some more examples. Right? So let's go up to the next line and drag that up there. And here we see, here's a pullback to that same pinkish line, pokes under it a little bit. What's to the left? An area of congestion, exactly where you'd be looking for buyers to step up. Now, what if you said, hey, I'm going to draw it from that one, because that's the most recent one, which leads to the question, which is the right one? Or do you use them both? Some subscribe to that. So here, prices broke down below the last line, which in Fibonacci theory is to suggest that the trend is broken and prices would go lower. Nothing could have been further from the truth. Now, let's take a look at the trend line right now. And let's forget that this is extending for the moment, but if beyond here, as if I just connected these two dots, and now your uptrend line is broken, which would suggest the trend is broken. Again, nothing could be further from the truth. What we have is higher highs, higher lows, higher high, higher lows. It's in an uptrend, and prices pulled back within that uptrend into an area of support where buyers stepped up. Large green candle, that's a buy as soon as it trades above the high. This line, now some would project that line and say, oh, look how the line is holding prices from moving higher. Again, not true. Projecting a line into the future is foolish thinking that you've created some resistance within the market and there's nothing there. This is just the way the market was moving up in a very tight, bullish consolidation. Little to no pullbacks along the way, whereas over here, where it was pulling back, there's a little bit more uncertainty about what's happening, and then that's why prices pull back, whereas here, as prices pushed up, there was a lot of certainty. That's why it didn't pull back. Buyers continue to step up, but in a smaller time frame, right? We can talk about multiple time frames and look at these little red bars where there would be pullbacks and the bottoming tail bars where there would be pullbacks. Here is where uncertainty grows again, which lasted about a year or so, and then prices pushed up. Let's continue with this Fibonacci analysis. So now you continue to draw here, since the other one didn't seem to work out, raising it up, you keep putting there, and now where do we go? Here, since we got some congestion there, but prices don't pull back. What happened? Something must be wrong. You're doing it the wrong way. All of these questions develop. The confusion starts. Maybe you were supposed to bring it up to this line. No, that doesn't line up. Or that line. That doesn't line up. Or maybe this one. Oh, it's starting to line up. So was that the right place? Or is this just a holy grail, foolish type of tool that is created to make you believe that by you connecting dots, one dot to another, you can find the hidden support and resistance levels within a market or within a stock? Now, what's happening now? Let's push this up to that low that was created and go up to this high. Now prices haven't pulled back. So are you now anticipating that eventually prices will pull back since you use Fibonacci retracements? Well, you can see again that if it did pull back into there, it's exactly where it consolidated for multiple months. So that could make sense if it actually pulled back into that area. Now, what about trend lines? Well, if we start using trend lines here, where do we draw that from? Well, this one didn't help us. Well, if I drew it and connect that here, well, it cut through there as if it broke the trend, but then it just resumed the trend and went back up again, which is the right place to draw these lines. Now, if I draw this here, is that the line? Did that stop prices from pulling back? No. Let's clean this up. Get rid of that. A second here to get the right tool. Now, as you start to delve into this and start asking the questions, and even if you are thinking that this actually might work because someone was showing it to you, well, now what happens when we start changing time frames? And now we've got all these other swing lows to deal with. This is where it really gets crazy. And so here now we can start drawing from different spots. Right? This is what Fibonacci aficionados do. They start drawing from different spots, and then where they see that these lines begin to overlap, this is where they tell you this is where there's going to be more support on a pullback, because you have variable Fibonacci levels in the same place and where prices are going to stop. Let's stop the craziness with these Fibonacci's and these trend lines, and what we need to do is look to the left. Now, areas of congestion like this, that's where there's support. So what do we do here? What's actually happening? Well, this is a concept that I call creating support. So initially, when this move down started, looking at this weekly time frame, the idea would have been, well, there's a little shelf here, and there's a larger shelf here. But it didn't get down there. So how do we deal with that? Well, the way you deal with it is a concept that I call creating support, and that starts with creating a swing low or a pivot where you have higher low bars to the left and the right. Once that happens, you then have a new reference point of support that wasn't there, and then when it gets retested, you look for buyers to step up. What's above here is a swing high, which is resistance. And we do that in multiple time frames and put that together in a very systematic way here at Master Trader. So I hope this has opened your eyes a little bit as to the subjective analysis tool called Fibonacci retracements and trend lines, and start looking directly to the left to where buyers have stepped up in the past. That's where they'll step up again. Where sellers have stepped up in the past, that's where they're going to step up again, and so on. So, good trading, everyone. Any questions, you're welcome to email me, Greg Capra, greg@mastertrader.com. Good trading.